Hi, I'm Tom Connor, one of the directors here at Drewberry. In this short video, we're going to talk through the basics of income protection. In particular, we're going to cover off these three questions. What is income protection? What are my options when taking out a policy? And finally, who should consider this type of cover? Okay, so firstly, what is income protection? Well, in a nutshell, income protection is designed to replace lost earnings if you were to be unable to work due to illness or injury. With some policies, you're also allowed to add cover for the risk of redundancy as well. But focusing on the illness and injury side, the policy doesn't list particular conditions that you can and you can't claim for. Rather, with all leading policies, you're able to cover any medical condition that prevents you from undertaking the duties of your normal occupation. So, for example, supposing that you're a manual worker and you slip a disc in your back, and the doctor sends you off to see the consultant says that you need to have surgery. Naturally, you can't work during this time, and there's going to be a period of recovery afterwards, so you'll be signed off from work. So the purpose of an income protection policy here would be to replace lost earnings whilst you're out of work, so you can keep up to date with all your bills. The first one that you need to choose is the monthly benefit. The monthly benefit is the amount that the policy would pay out to you each month if you were to have to take time off work due to illness or injury, or in some cases redundancy if you have that cover included on the policy. Now, when setting the amount that you want to cover each month, it's important to ensure that you consider and tally up what are your core essential outgoings. So these will be things such as your mortgage, your rent, your grocery bills, utilities, council tax, anything that really has to be paid at the end of the month. It's important to remember that the higher the level of cover, the higher the monthly premiums will be. So if you're on a budget, a good place to start is with those core expenses and then add additional cover on from there if it's affordable. Right, the next option to talk about is the deferred period. It sounds like a technical term, but really all it's saying is the deferred period is the amount of time that you would need to wait before becoming ill and your policy kicking in. So often people, if they have sick pay, for example, if you have a month's worth of sick pay from your employer, may set the deferred period at 30 days. This means that after 30 days, the policy would kick in. So before that, you have your employer's sick pay. After that, you have the policy. So there's that continuation of income. It's important to remember that the longer the deferred period, the less chance there is that the insurer is going to have to pay short-term claims. And therefore, the longer the deferred period, generally the lower the premiums. This can make a significant difference. With some insurers, if you go from a deferred period of say 4 weeks to 13 weeks, it can reduce the premiums by as much as 50%. So often if people have savings as well, so they may say have a month's worth of sick pay and they may have say 2 months worth of savings in their bank, they could afford to stretch out that deferred period and lower their monthly premiums. Right, the next option that you'll need to choose is the policy length, i.e. how long the policy will run for. With income protection, it's usually to a specific age. Often it might cover you to retirement age, i.e. so it's covering your entire working life. So often you might set that to your state pensionable age, which could be between 65 and 67 at the moment. Or alternatively, it may run for a period of time that covers a specific liability. So for example, if you have a mortgage and the mortgage has got a 20-year term, it might run for 20 years. Now, as you get older, the chances of suffering illness or injury increase. So the longer the policy term, the higher the premiums. The next option that you need to choose is the premium type. Now, like with car insurance, you can have, which tends to come with reviewable premiums, i.e. each year the insurer can make a decision about whether they increase the premiums or not. With protection policies such as income protection, you can have guaranteed premiums as an option, or you can choose reviewable premiums. With guaranteed premiums, the premiums are fixed over the life of the policy, so they can't change over that life. So if you have the policy for say 20 years, they'll be fixed for 20 years. Naturally, with the reviewable premiums, they can increase over time. The other third option, which you have with income protection, is what's called age-banded premiums. With age-banded premiums, they're age-rated. So as you get older, the premiums increase with time. So generally speaking, the guaranteed premiums tend to be the highest at the start because they're fixed over time. Reviewable premiums tend to be a little bit lower because the insurer does have the right to increase them over time. Say, for example, if their claims experience is higher than what they expected. And then lowest of all, you tend to have the age banded premiums, but they do tend to shoot up quite a lot, especially in the latter ages of life. The next option that you'll need to choose is the payout length. This is the period of time that the policy would pay out for a maximum should you need to make a claim. Traditionally, there was only one option with this. It would pay out either until you are well enough to return to work or you reach the end of the policy length. So for example, if you had a policy that ran for 20 years and you were to suffer something that was particularly nasty, maybe paralysis as a result of a car accident or Parkinson's, for example, and you could never return to work, the policy could pay out all the way until that end of the 20-year term. Since then, other options have entered the market with lower premiums, but they would limit how long they would pay out for. Typically, policy options with regards to payout length are 12 months, 24 months, 5 years. Now with this, it's important to be very, very careful. Although the premiums for a policy that could pay out for say a maximum of 12 months might look attractive, research from a lot of insurers in terms of their average payout lengths for income protection range from say 5 years to 7 years. It's a surprising length of time, but when you look at all the serious medical conditions that you could suffer from, it's quite easy to see how that time could add up. Now, if you were to have a policy which could only pay out for 12 months and you would suffer something that was particularly serious, then you could easily find yourself in a situation where you reach the end of the 12-month period, you're still unable to go back to work, but the policy payments stop. Now that's not a position that you want to be in. So generally, if you have budget and you can afford a policy that wouldn't limit how long it could pay out for, i.e. it would run to the end of the policy life, then that would generally be the best option. The next one we have on the list is occupation definition. It's not really an option. I can put it on here mainly as a warning. Most policies these days will cover you in what's called the own occupation definition of incapacity. This means if you're unable to undertake the main duties of your particular occupation due to medical reasons, then the policy will pay out. It's very straightforward, clear-cut, it's as you would expect it to be when taking out an income protection policy. Now the warning is there are policies on the market with lesser definitions of incapacity. For example, there's one on the market with a suited occupation definition. With this, at claim stage, the insurer would assess your skills and experience and determine whether they think that you're capable of undertaking another job for which you're suited. For example, if you're a pilot and you lose sight in one of your eyes, it's common for you to lose your pilot's license. In this example, the insurer could say, well, given your skills and experience, you could teach student pilots navigation, even if it meant that you had to take a significant drop in income and therefore not pay out. Even worse than this, there's the any occupation definition of incapacity, where the insurer could literally say, well, are you capable of undertaking any other job? So given these lesser definitions, we strongly recommend that you steer yourself towards own occupation so you're covered comprehensively and you know where you stand. So now we've covered what policy options you have when taking out your policy. The last question is, who should consider income protection? We arrange income protection for a very, very wide range of people. From self-employed people who have no sick pay at all, through to doctors and surgeons that have as much as 6 months of NHS sick pay. Really, if you would suffer financially and struggle to pay your bills if you lost your income, then income protection could be suitable for you. It's really as simple as that.